From the morning reading, stocks take off. Best close since August drop. The spider has horizontal breakout. Bull flags bounce. All sectors moved higher on Thursday. XLF, XLV, XLE were the strongest sectors, while XLB was the weakest sector. Market breadth strengthened as advancers led decliners 4.35 to 1 on the New York Stock Exchange and 4.34 to 1 on the Nasdaq. Dollar weakens as two-year Treasury yields fall to three-month low. That combination is pushing precious metals higher. Gold has retraced 50% of its previous bull market, which puts it in a potential support zone. Dollar falls with U.S. rates. U.S. interest rates have been dropping on reduced expectations from a Fed hike rate this year. The two-year Treasury yield falling yesterday to its lowest level in 3 months. That's important because that shorter-term yield is more sensitive to Fed moves. Bond yields have also been falling. One of the side effects of lower yields is a weaker dollar. UUP dropping as well over the last month. That's because lower rates make a currency less attractive. A weaker dollar has a lot of intermarket implications. The most direct intermarket effect is higher commodities and stocks tied to them, which includes energies and materials. The combination of lower rates and a weak dollar is especially good for precious metals and their related stocks. Gold exceeds the 200-day average. Precious metals like gold and silver have had a very good month. The daily bars show that the Gold Spider GLD moved above its 200-day average yesterday for the first time since May. It has also broken a falling resistance line drawn over its January-May highs. Gold also established a bullish pattern of rising peaks and rising trough since August, as has silver. I suspect the new strength in precious metals is part of a potential bottoming process in most other commodities. That includes copper, energy, and agricultural commodities. Gold miners are following the commodity higher. The daily bars show the gold miners ETF GDX also exceeding its August high to turn its short-term trend higher. It still has to clear the 200-day average, however, to signal a more substantial rally. The GDX-SPX ratio also shows new relative strength for gold and some silver miners. Financials lead the market higher. Bank of America, Citigroup, and Goldman Sachs lead. Emerging markets lead foreign stocks higher. S&P closes at a 2-month high as Nasdaq closes above the 50-day line. VIX falls 10% to a 2-month low. Bank stocks had a strong day. Financial stocks led a strong day in stocks. Several big bank stocks had big chart days. The daily bars of Bank of America surged more than 3% in heavy trading. It's also testing its 50 and 200-day moving averages. Citigroup had a similar situation after gaining 4%. Goldman Sachs scored an impressive upside reversal in heavy trading. The fact that all three stocks are bouncing off support levels formed in January is also encouraging. Financial stocks have been market laggards over the last 2 months. Today's strong chart action suggests that may be changing for the better. Foreign stocks have a strong day. Today's rally was global in stock. EFA closing at its highest level in 2 months. Japan was the biggest developed gainer. Emerging markets did even better. EEM gaining more than 2% and hitting its highest close since early August. Chinese stocks led the EEM rally. Strength overseas spilled over to the United States. The S&P 500 hits a 2-month high. U.S. stocks continued the rally that started in late September. The Dow gained 217 points. That was 1.2% to extend its rally. The S&P 500 gained an even stronger 1.5%. More importantly, the SPX closed at 2023, which exceeded its mid-September intraday peak at 2020. That put the SPX at new 2-month high. The Nasdaq was even stronger. The Nasdaq gained 1.8% and closed above its 50-day average for the first time since before the market slide in August. The fact that small caps did even better is a good sign. The Russell 2000 small cap RUT gained 2.2 to regain its 50-day average. All market sectors rose, with the biggest gainers in financials, 2.4%, a 4% gain in biotechs led a healthcare gain of 2.6%, and energy 1.8%. Consumer discretionary stocks rose 1.2% to regain all of yesterday's losses and more. To top it off, the VIX index fell 10% to close to a 2-month low at 1605. VIX closed below its 200-day average today. The big question is whether global stock indices will be able to exceed their 200-day averages. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:02 a.m. Central Time, and I'm recording this in preparation for the market day of October the 16th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Let's dive on in. Now, I hope you found that that rather extensive amount of morning reading was helpful. I know it's a bit hard to follow that much content, but yesterday was a really important day, and let's go ahead and dive right into the charts. When you look at the SPX, as I mentioned in the morning reading, this high, we closed at the highs of the day. This is very bullish for a number of reasons. One, you had a big bullish body candle, but two, look at the close is at the high of the day, and the close exceeded all this action from the recent rollback, and that also exceeded the FOMC wick. So we have cleared and this recent level of resistance. Now, obviously, we'd like to see confirmation and continuation of this pattern, but we've been talking ever since we came back and retested this low that we were going to have significant resistance above. It quickly moved up to this level here, which we figured was the easiest part. And though it stalled there momentarily, it clearly moved through in relatively short order up to the next line of resistance, this FOMC wick. That was another stall point. But then yesterday, we confirmed with a close through that level. So the next level now is probably up the 2040, 2050 area, which is not that far away, easily attainable even in one trading session. In terms of the distance there, it's about 20 points or so, and that would put us back within the range, the prior range. And if you go back, you see we spent weeks trading in that range. So that area should serve as some resistance. That 2050th area, we'll pretty much call it, should serve as resistance. And I wouldn't be surprised if, once again, much like we saw here and then here, that it at least serves as some sort of temporary resistance. But this is very, very strong action. We went 150 points between here, and then we've just continued this pattern with hardly a break. So, you know, that this was very healthy to have a little bit of an exhale here for a couple days, but off we go to the races once again. You have to just recognize just how much has changed, and that's part of the reason why I justified having that much content in the morning reading. Russell also very, very bullish action yesterday, though on a relative sense, you know, still behind the action of the SPX. Now, as a percentage, this actually moved more than the SPX yesterday, so that's very good. But we still have to retake this swing high, and we then have to retake the prior swing high and the FOMC. So this really has 3 levels of resistance just to catch up to where the SPX is playing effectively up in this area. So you can see the Russell is a good deal behind. And the Nasdaq, also big bullish action, still has to overtake the FOMC wick. So again, behind the SPX. Normally we like to see the Nasdaq and the Russell lead, and while they both had very bullish action yesterday, from a relative sense on the charts, they're still behind. Now that's not the case with the Dow. The Dow is ahead of everybody, and it basically is right on the verge of coming into this prior range for the Dow. So very interesting action going on in all those places. We also mentioned in the morning reading, one of the authors talked about the VIX, and here the VIX, the volatility futures, VIX futures. We've been looking to see this breakdown below 18, and we certainly seem to be doing that. And so far, the action today, we would be somewhere around 16 3/4. So this is definitely breaking down below 18 and starting to play in the land of bull markets in that 12 to 18 range. So very interesting on all those fronts. Let's dive into the morning report. Overnight action on all four of the broad market indices was slightly weak at the time of this cut. It's still that way so in live action. But not enough here to get excited about anything. In fact, you could call the Nasdaq just essentially scratch, and the others just moderately down. Crude oil up about 1%. Those of you that trade crude oil, we're still on our guides using the November contract, but about half the volume is now on the December contract, so that contract's in the middle of rollover, so be aware of that if you are an energy trader. Could be kind of sloppy today, should be cleaner trading come Monday when everybody will probably be pretty much on the new contract. In terms of the euro, down about 1/4% or so, bonds up about 1/3%, gold down about 2/3%. In overseas action, pretty strong evening last night. China up about 1.5%, Hong Kong up about 3/4%, Japan up over 1%, Germany about 0.5%, and the United Kingdom up about 2/3%. Macroeconomic reports for today, there are some. This is a Friday, normally a little quieter, but we do have some reports coming in today, mostly to do with manufacturing, to build on yesterday's manufacturing related reports. Capacity utilization, industrial production, and during market hours, always this one seems to catch people. University of Michigan consumer sentiment, JOLTS job openings, inflation expectations. So a number of reports coming out during the day as well. From a volatility standpoint, VIX short term 13.85. That's got to be about the lowest we've seen at least in a couple months. Skew, though, continues to be very elevated, and we've seen very high ratings in skew all week, and that is one of the warning signs, and we'll talk about that more in just a moment. IV percentiles, look at these. I mean, they're not just in the lower quartile anymore, they're in the lower fifth. 20 percentile, 15, 18, 18. We did see standard deviation moves coming in, and you look at this, I mean, normally when we think of 3, 4, 5 standard deviation moves within 2 trading weeks, we're thinking the market's probably down in week. These are all pretty much bullish, and indeed all 4 indices had standard deviation moves put in yesterday. As we mentioned, the Russell, the biggest relative move, 2 standard deviation move put in, and you look at this, 1, 1, and 2, 3 trading days in a row. And that is a big move from bottom to top in those 3 trading sessions. In terms of our daily report, we continue to see improvement, but still warning signs. We still call this a market in some transition, but less so. This is starting to show more evidence that we're truly breaking into bull trend conditions. In fact, in phase 3, we're calling this a, in terms of the intermediate term phase opinion, the phase 3 type market, which is bull flags, and looks like we broke out from a bull flag pattern here just in the last couple trading days. In terms of investor postures, IBD status confirmed uptrend. Accumulation distribution score on the S&P is a B-, so not too shabby there. Nasdaq still in much poorer condition, but did improve yesterday to a D minus. GMI index a 3 out of 6 with a sell signal that flip-flopped just this week. That author is still in cash. Primary market condition, when you look at the relationship of the moving averages, one on top of another, still strong bear, though that could be changing here soon. Decision point scoreboard still showing up arrows on the short term across the various markets, but not in the intermediate and long term. So that continues to be a signal warning. In terms of the intermediate term market posture, very bullish. Short term sentiment had weakened, and we wondered going into yesterday whether that was enough to signal a posture change. That would seem to have changed now, and with this most recent breakout on the S&P, most likely we'll be able to sustain a bullish posture. In terms of position sizing opinions, both opinions are now at up to 100%, so that's an improvement. Intermediate term market posture, very bullish still, though had a change here in the Nasdaq. It had flipped to bearish the day before, now back to very bullish. And indeed, you see S&P 92.5 very bullish, Dow 93.4 very bullish, and Nasdaq at actually bullish at a 71.1. Russell remained in bearish territory on this intermediate term market posture, but that could turn with probably another strong day. Hedge warning status remains level 1. We do still see a number of kind of important warning signs here. Decision points, GMI index, primary market condition, all certainly influencing this opinion. You also had this skew, and this skew yesterday was up over 145. That gives us a 14.5% probability of a 2 standard deviation move in the next 30 days. And the implication to that, by the way, is that it's a 2 standard deviation move down, not necessarily up. That's what people worry about, and that's why they're buying protection. So as we have broken out to these highs, when you look at the amount of protection being bought by institutions, it has been exceptionally high. So that should be taken as a serious warning to the rest of us that this is not all bull all the time. There are definitely very, very serious warnings still remaining in this market. And indeed, I mentioned yesterday that these were all 5 risk on in the intermarket risk aversion indicators, but that some of these were very tightly wrapped and could very easily fall. And indeed, 2 of the 5 fell below and signaled risk off yesterday. So we continue to again see these warning areas. In terms of position strategy opinions, no changes here, so I'll let you read that. If you need more time, just hit the pause button, but I won't spend any more time with the amount of morning reading content we had today. That is the same. In terms of sector specific, you can see a wall of green here on the short to intermediate. Obviously significant improvement in market postures. Retail, of course, having to overcome continued weakness in retail, and indeed Walmart was down even more yesterday. I know a lot of people were thinking that it was a great opportunity to jump on Walmart with the big 10 standard deviation move down on the day prior. To me, when I see a move that's much more than about 3 standard deviations, I prefer to wait and see stabilization. And that seemed to be the right call. There'll be an opportunity, and heck, I might even take a position in Walmart today, but I want to see some stabilization. And as it stands right now, Walmart lost again yesterday, and not just modestly, but it was over 1%. So it is definitely impacting the entire retail space, and that's why you see that as the lone sector there. In terms of percent change, you look at the numbers here. This was a big day. I mean, every single sector except one was up, essentially 1% or greater, and some of these were up over 2%. Healthcare, remember, biologics the biotech have been really beat up, and healthcare in general, by some of the action, from Hillary and others in the Democratic Party coming out against healthcare. And that really had taken a hit on a number of these companies. Well, they seem to be forming a bottom pattern and seem to be bouncing from there. So, that's the first sign of some not just consolidation, but improvement and confirmation that perhaps the bottom has been set in that sector, like IBB and others. That should be more than enough for today. As always, if you find what we're doing here is helpful to your trading, we appreciate your acknowledgement of that by retweeting us to your Twitter followers, to your StockTwit followers, liking us on YouTube, subscribing to us on YouTube. Direct emails can be sent to support@falconglobaltraders.com. Disclaimers, as always, hit the pause button if you need more time to review. And we'll see you back here Monday morning for the market preview from Falcon Global.